In this video, I'm going to show you why your business should be taxed as an S corporation instead of a sole proprietorship. And here's a bit of a spoiler alert. It's because the S corp can save you thousands of dollars in taxes. So let's have a look on my screen here. We've got an example where if you're taxed as a sole proprietorship, that means in this instance here that you've got revenue of $125,000. Okay, your business had sales of $125,000. Now, naturally, in order to have $125,000 in revenue, you probably have some expenses. So in this example, I'm saying you got $25,000 of expenses and you land at $100,000 of profit. Now, if you're being taxed as a sole proprietorship and you want to get access to this money, then you're going to take an owner's draw to pull out that 100 grand. Now, whether you pull out it or not, you're still going to get taxed, but the way you pay yourself, if you will, is through an owner's draw. And so what's going to happen here is on the $100,000, you're going to pay two types of tax. $100,000 times the 15.3%, that's self-employment taxes, that's Social Security and Medicare. That's $15,300 in Social Security and Medicare tax. On top of that, you're going to pay income tax. You might be in a state that has state income tax as well, but I'm just going to say you're going to pay about 15% in taxes. So it's $100,000 times 15% in income tax, which is $15,000. So your total tax paid on earning $100,000 of profit is $30,300. You could do the math on that. That's over 30% in taxes, okay? Now, what happens if your business is taxed as an S corp? Nothing changes, right? You're still running the same business. You made $125,000 in revenue, $25,000 in expenses, and you'll land at 100 grand in profit. Well, the difference here is that instead of taking this as a owner's draw, you're going to take this money out of the company in two different ways. One is a salary. You might have heard that referred to as a reasonable compensation or payroll. And you're going to take, let's say, 40% as your reasonable compensation. All right. The other amount you're going to take as a distribution. That's just transferring money from your business checking to your personal. The difference here, by taking the money out of your company this way, has to do with your tax savings. So on the $40,000 that you took as salary, that you still have to pay Social Security and Medicare taxes. It's called FICA tax when you're an S corporation, okay? But it's the same thing. Social Security and Medicare, self-employment tax, very similar. So it's 15.3%. So the 40 grand times the 15.3% is $6,120. On the $60,000, the amount that you took as a distribution, you don't pay any FICA taxes, no Social Security and Medicare taxes, so it's $0 there. You're still gonna pay your income tax because you made 100 grand in profit, right? So the 100,000 times the 15% in income tax, 15 grand. How much tax are you paying now? $21,120. What's the difference? It's $9,180. It's the $30,300 minus the $21,120. You're saving $9,180. If you found that this was helpful, you could follow me. My name is Navi Miraj. I'm a CPA. I'm on all the social media platforms. This is my handle, Navi Miraj CPA. Check out my YouTube channel to learn more. I don't want you rushing out and becoming an S corp just by watching this short video. Check out those long form videos that'll teach you more about the S corp there.